This is the Asia Trade. I'm Paul Allen in Sydney, where the markets have just opened.
I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set for gains after Wall Street climbs for a second day. Economists see evidence of a modest US slowdown rather than a potential recession.
But the OECD is warning that Trump tariffs will stoke inflation while curbing growth, with nations in the centre of the trade storm seeing the biggest decelerations.
Plus, the Kremlin confirms President Putin will speak with Trump on Tuesday as the US leader pushes for a Ukraine ceasefire.
Right, well, it was a positive day for US markets. Most indexes modestly higher, S&P up 3/4, well, 2/3 of 1%, let's call it. But we're seeing futures pointing modestly higher as well for the next session. NASDAQ futures higher as well. Now, we did see oil prices ticking up. They're giving up some of those gains that we saw a bit earlier, now off 1/3 of 1%. Oil has been moving a little bit higher on risk premium. We'll tell you more about this in a moment. But President Trump says any more Houthi attacks in the Red Sea, Iran is going to be held responsible for those, and he's not ruling out possible strikes on Iranian ships in the area as well. China demand picture is also encouraging, helping support oil prices at the moment. Got the dollar spot index continuing to weaken ever so slightly, and of course we do have this continued shadow being cast over global growth. The OECD's been sharing some thoughts on that. Let's have a listen.
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1%, and next year by 0.3% down to 3%. And I mean, it's a function of the data pointing to a weakening in the global economic outlook, but also inflation remaining more elevated than we had previously anticipated.
Well, despite these ongoing global growth concerns over Trump tariffs, we are expecting a potential update when it comes to Asian equities, really expected to track those gains on Wall Street, that bounce, lending a little bit more shine to this part of the world as well. We are seeing Sydney stocks just coming online after we saw Aussie stocks gaining the most in 2 weeks, with a lot of those gains being concentrated in the miners, the financials and the banks as well, in those two largest sectors leading that rebound. We'll be watching that very closely as well as we continue to watch Japanese assets as well. The BOJ expected to keep its policy rate unchanged at its two-day gathering. We're, of course, looking ahead to the Fed as well. JGB's worth continuing to watch, given that we've seen that longer end of JGB's, a 40-year yield briefly topping 3% yesterday. That was the first time ever. The 30-year also sitting up about the highest in 19 years as well. So one asset class to watch there. We're also watching broadly to see if there's any more reaction when it comes to that China consumption plan, which Bloomberg Economics is calling skeletal at this point, but off to a good start.
Well, for more, let's bring in our executive editor for Asian markets, Paul Dobson. Paul, just want to start with what we saw in the US session overnight. A rebound there, second day in a row. Is this looking sustainable? Can we say that the bottom is in as tariff and jitters subside, albeit on April 2? We're going to get some more news on that front.
Yeah, exactly. I think that it's too early to declare the all clear here. But what we did see in the session on Monday was a very broad rally, more than 90% of the companies in the S&P 500 rising. So that talks to an idea that, there was a general sense that the sell-off had been too far, too fast, and that this recovery, this bounce from entering correction territory had a little bit further to go. People stepping in to buy that dip. But yes, the question is, how sustainable is it? Everybody thinking about what is April 2 going to look like, given how much Trump has been talking it up as a great day, as one where we're going to see those reciprocal tariffs come in right across the board. And I think the market probably took some heart from reports that we had overnight talking about it, a little bit of a more kind of what would be the right word? More measured way of introducing and calibrating these tariffs. Some people in the Trump administration really pushing the idea that you need to follow the legal channels a little bit more carefully on this one. Can't just use emergency acts and declarations in order to get everything through. And I think that the market probably likes that if it means that things are more measured. That they're going to be tempered and customized and suitable for the current environment. So perhaps that takes us away from something that's a little bit more radical and causes those kind of whiplashes that we've seen in markets in recent days and months, and gives the investment community a little bit more confidence, which is the thing that's been lacking in recent trading sessions.
Confidence has also been the thing that's been lacking when it comes to the broader hopes for a Chinese recovery, right? The, latest kind of consumption blueprint, if you will, trying to address some of these chokeholds when it comes to what's holding back household confidence. Do you think this is a game changer? Does that continue to drive the outperformance that we see in Chinese assets?
Yeah, Heidi, no, I don't think game changer, but people are gaining confidence in these incremental moves. This is no big bang. We didn't see any cuts in the RRR rate or in the policy rate still. It's, lots of little bits and bobs that are all helpful. And it talks to this idea that China is paying a lot more attention to the need to revive consumption. It's talking about, getting more loans out there in the economy. It's talking about childcare. It's talking about unemployment benefits, raising the minimum wage. They're all helpful in terms of pushing it. But it is really, exactly as you said, that confidence that is the thing that you need to change, and changing that mindset among consumers once they've really got into that kind of bunker mentality is very difficult and will take time. Without a big bang, it's more progressive. What we did see, though, is a very big gain overnight in US traded Chinese equities. So that talks to this idea that maybe international investors at least are convinced that the momentum is there, that we're moving in the right direction, and that you can continue to put some faith in there, particularly when people are worried about the valuations in the US market and looking for alternatives as well.
Paul, I couldn't help but notice that you repeated the phrase talking about a few times there. When does the talking actually result in some sort of concrete action? Is this something that markets are a little bit more eager to see?
I think everybody would like more concrete action. I think you have to be patient when it comes to China in particular. Everything has to go through all of these processes and stages in negotiations and be distilled through all of the different bureaus. We are seeing, individual provinces and regions acting a little bit more, but we're not seeing kind of a big altogether coordinated kind of a move. I don't think that that's necessarily going to come. I think particularly the authorities are pretty confident that they'll be able to meet the 5% goal. They're quite happy with the way that tech is coming through after DeepSeek. We're seeing a lot of follow through on that, a lot of extra announcements. We had some changes this week for Baidu, for the only bot that the market seemed to like quite a lot as well. And things like that are really, giving the authorities confidence that if they just keep, keep the wind in the sails, then maybe that's enough to get us through this year, hit those growth targets, and probably come out of it in a little bit calmer waters at the end of it.
Well, we're also watching the BOJ, right? The big move that we see in JGB yields, is that more reflective of what we're seeing in terms of catching up to treasuries as opposed to sort of any shift in fundamentals for Japan?
No, I think it's a Japan story, really, Heidi. I think, the BOJ has been quite clear in saying that it's happy and comfortable with where yields are at the moment. It's happy with what the market is pricing in terms of when the BOJ is going to hike next. We might not see anything this month, but we are going to be looking forward to the prospect of more interest rate increases there. The BOJ wants to get policy higher. Inflation is coursing through the Japanese economy. We're seeing that coming through in the wage growth in particular. It's giving those policymakers confidence that they can keep on lifting interest rates, and that's pushing out across the back end of the yield curve as well. The idea that we will have a sustainable exit from the deflationary environment. So that continues to push those wages higher. It has those knock-on effects of giving the yen additional support as well. And probably whisper it, maybe this is a healthy thing rather than a terrible thing for the economy and for the global markets.
Bloomberg Executive Editor for Asian Markets, Paul Dobson there. Well, traders will be looking ahead to April 2nd. Of course, as Paul mentioned, President Trump expected to unveil new tariffs, and his top trade negotiator will be looking to inject order into that after some previous announcements roiled markets. Let's bring in Bloomberg's China correspondent, Min Lo. So, Min, what are we hearing in terms of how this could perhaps be a process that's less chaotic than the news flow that we've had so far?
It's still very chaotic because, I mean, when Trump announced these on and off tariffs, it's sometimes been announced on social media, at impromptu press conferences. And so far with the Canadian, Mexican and Chinese tariffs, Trump has been able to roll that out very quickly by using special economic powers granted to him during times of national emergency. And he cited drug trafficking as a reason for that. But there are now questions about whether the reciprocal tariffs will be able to use the same sort of legal powers given to him for that basis, because those tariffs are imposed due to trade imbalances, and that may not necessarily fit into the legal definition of a national emergency. So it could face some legal challenges, and the new trade representative, Jamieson Greer, is now reinstating parts of the traditional policy-making process by asking for public comments on these levies, gathering feedbacks from businesses and stakeholders. And of course, that is a process that could take weeks or even months, and it could delay the implementation of these tariffs. At this point, there's still questions about how the tariff is actually going to be implemented and calculated. There are some talks about how it could be a single rate based on the tariffs from different countries and their non-trade barriers such as wages and tax cuts. Lutnick had mentioned to Bloomberg that some of these tariff rates could be announced immediately. Some could take weeks, or could take weeks to be calculated, and that rate could also be changed based on Trump's perception of how these countries, how cooperative these countries are with the U.S. So still a lot of questions as to how that rollout is going to be, because it's an enormous undertaking to figure out what the rate should be for every single country.
If we take a look at the case of Canada, for example, and retaliation, we've had some retaliation already announced, but how much firepower does Canada and the US's other trade partners actually have when it comes to pushing back?
Well, for Canada, not a lot. And the Canadian Prime Minister had mentioned that they don't have the power to match those tariffs dollar for dollar because of the trade relations and how Canada is in some ways quite reliant on the U.S. economy, their biggest trade partner. The Canadian Prime Minister is saying that the most that they can push it to is to target about 100 billion Canadian dollars worth of imports from the U.S. And not more than that. And we know that there has been some talk about whether some of Trump's traditional allies would look to plan a sort of coordinated retaliatory action against the U.S. We know that the new Canadian Prime Minister had just made his first overseas trip, where he met with the French President Emmanuel Macron. He met with the UK Prime Minister Keir Starmer. But so far he has denied that, or he said that he's not pushing these partners to take further action on U.S. He's respecting these countries' bilateral relations with the U.S. We know at this point, for example, UK has not taken any retaliatory action against those steel and aluminum tariffs from the U.S. last week.
All right. Bloomberg's China correspondent Min Lo there. I want to check in on one of the big movers here in the early going in Australia. It is Austal. This is a defence contractor, up about 6% right now. It was up more than that a little bit earlier on. Now, this is on the news that South Korea's Hanwha Aerospace has taken a 9.9% stake in the company. Hanwha was interested in pursuing Austal about 6 months ago and then walked away, but now it's made this purchase with $180 million, or up to that amount. So if that holding, currently at 9.9%, goes above 10, then Hanwha is going to have to ask for Foreign Investment Review Board approval to increase its stake further. But Hanwha itself surging as much as 17% in South Korea yesterday, and now defence contractor Austal along for the ride here in Australia. Heidi.
Paul, coming up on the Asia Trade, we're going to take a closer look at why Chinese consumer confidence remains weak with CLSA. Port Shelter CEO will be coming along with us too to tell us how Trump's economic policies could accelerate the financial pivot to China. Plus, taking a look at the impact of those Trump tariffs on Australia's economy and that bilateral relationship with the former US ambassador. Much more ahead. This is Bloomberg. Take a look at what we're watching when it comes to that expected bounce in the Asian session, really coming through from the much sort of awaited for recovery that we saw on Wall Street. Take a look at crude in particular. We're seeing a rise there after really quite a lot of sideways and downwards trading over the past few weeks and months. The China consumption stimulus plans adding some hope that we could see that confidence restored and demand coming through from the Chinese economy. Some optimistic economic signals from the US as well, adding to that, as well as these concerns about a widening Middle East conflict. The US attacks on Yemen's Iran-backed Houthis and President Trump's comments regarding this area really reviving some of the concerns over geopolitical tensions, which may spill over into oil prices. Well, President Trump is also set to speak with his Russian counterpart Vladimir Putin on Tuesday amid a US push for a ceasefire with Ukraine.
Tomorrow I'm speaking with President Putin of Russia to save some soldiers who are in deep trouble. They're captured. Essentially, they're surrounded by Russian soldiers. I believe if it wasn't for me, they wouldn't be here any longer. I was able to get them not to do anything at this moment. But it's a bad situation in Russia, and it's a bad situation in Ukraine.
Bloomberg's national security reporter Daniel Flatley joins us now. So, Daniel, when it comes to, I guess, the dynamic and momentum of these talks, what are we expecting? Because since the last sort of development when it comes to Ukraine, the ball has felt very much to be in Putin's court.
Yes, Heidi, definitely. You know, it's been a lot has transpired since President Trump's last phone call with Putin, including the Oval Office blow up with President Volodymyr Zelensky of Ukraine. We now are at a point where it appears that the U.S. has Ukraine on its side, and last week there was the news about a 1-month ceasefire, and so that will be one of the items that we expect President Trump will speak with President Putin about tomorrow. But you're right to point out that at this point, Russia has not really given much ground or signaled that it's willing to give much ground, both literally and figuratively, in terms of what its demands are, what its aims are with this war in Ukraine, and what it's willing to concede in order to get that ceasefire agreement in place. And so I believe that, you know, President Trump is hoping to bring his deal-making acumen and his salesmanship to the call, and certainly a fair amount of leverage on the part of the United States to try to get Putin to agree to some sort of ceasefire, or absent that, something perhaps short of that. But there is some concern that with Russia having a little bit of a stronger hand in terms of what they have, what the situation is on the ground in Ukraine at the moment, that they may, that Russia may get more out of this deal than Ukraine. And so that's something that we'll be watching for very carefully over the next 24 hours.
Yeah, and at the same time, we've got the UK, the EU holding talks on how to seize frozen Russian assets, perhaps use that money to help fund the war effort. Kind of begs the question, why hasn't this been done earlier?
Absolutely. Yeah, I mean, it's a great question. You know, I've followed this story for the last 3 years, from the moment that the sovereign assets were seized from the Central Bank of Russia, through the debates over whether or not the proceeds from those sovereign assets could be used to help with the reconstruction of Ukraine, to now to some discussion, which is really kind of a new part to this ongoing saga, whether these assets could be used to help pay for European defense. And there's a lot of legal questions that, you know, go along with this as this debate has unfolded over the last several years. And so I think what you're going to see as these discussions unfold is a very legalistic kind of debate over how the UK and some of the EU partners can use this money to help shore up their defenses against Russia. And of course, there is the question underlying all of this. Do they have the right to take those assets from Russia? Is this the type of extraordinary circumstances, a wartime environment in which that would be permitted? What are some of the legal questions around that? They were somewhat resolved in some clever maneuvering around the Russian sovereign assets and using the proceeds generated by the interest in those assets for the benefit of Ukraine. This is going to be a little bit of a different situation, so we'll have to see how that all plays out, but certainly very interesting development.
We've also seen these remarks when it comes to Iran, really ramping up the pressure, not just on Iran, but of course also any Iranian proxies by President Trump.
Yes, it's this situation in this part of the world has been going on now for several, really since the October 7th, 2023 attacks against Israel by Hamas, and so you've had this issue really become more inflamed over the last couple of years. There's been ongoing operations on the part of the Biden administration before the Biden administration left office, trying to disrupt the Houthis and their attempts to disrupt shipping through this corridor. And what you see now is really a ramp up in rhetoric from the Trump administration and a little bit more of a more aggressive posture in terms of airstrikes and other activity in the region. What we do know, just historically speaking, is that the U.S. and its allies, particularly Saudi Arabia, have been prosecuting a campaign against the Houthis in Yemen for years now and have been unable to dislodge them from that area. So it's a question really of how far is Trump and his team willing to go in terms of attacking sites that may cause some collateral damage, some civilian deaths or civilian injuries. And then, is this really going to become a proxy battle? I mean, it already is to a certain extent with Iran, but how far are the Trump administration officials willing to go in terms of carrying out some of the rhetoric that they've put out there against Iran? And so that is something that, could potentially have some impact on oil markets, but certainly is something that we'll have to keep an eye on as things go forward.
All right, Bloomberg national security reporter Daniel Flatley there. We have more ahead on the Asia trade. This is Bloomberg. Seeing a risk on sentiment here in Australia, the ASX pushing higher by about a little more than half of 1%. The materials sector, the only laggard. We have been hearing from the RBA Assistant Governor Sarah Hunter, acknowledges clouded outlook for US policy, but says the bank remains data dependent. More ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching when it comes to Chinese assets, given that we have had, I should say, cautious sort of hope and enthusiasm that some of these consumption, at least the strategy is sort of pointed in the right direction. Some of the policies that we've seen, certainly that was the reaction when it comes to US-listed Chinese risk assets there. The Golden Dragon China Index rallying in the overnight session. We also see that move when it comes to the A50 China futures at the moment as well. Well, the central bank, the PBOC, looking to create new monetary policy tools to drive consumption. That includes support for asset securitisation with consumer and car loans as underlying assets and a variety of bond investments. China's top economic planner says a special action plan will boost consumption on the demand side. Joining us now is Chris Gull, who's a China consumer research analyst at CLSA. Chris, really great to have you with us. And there seems to be, a bit of enthusiasm, even though the details are very thin when it comes to what this new boost to consumption is, other than obviously they want to address some of the choke points that might be holding back broader confidence for households. What do you make of what's been announced so far, and what really kind of needs to be announced further, given that this has been, you know, an ongoing problem and a drag on growth?
Okay, thank you. Good morning, Haidi. Good morning, Paul. So market focus has definitely been on the vigorous boost of domestic consumption measures from Chinese government lately. We know that last weekend there was a special action plan to boost consumption with 8 pillars of strategies. And yesterday, the consumer media briefing hosted by State Council Information Office was also in place. So right now, as you can see, household income improvement stands at the top priority of the government work. So basically, if you look at yesterday's briefing, the briefing, although mainly recaps the special action plan announced during the weekend, the tone largely in line with the market expectations. Some numbers were confirmed and some details are still pending, but the tone is actually quite clear. The household income outlook boost, as well as diversifying the resources of the income from households, as well as improving the consumer environment, boosting the diversification of the emerging subsectors of all kinds of business under the consumer is in government plan. So right now, what are still pending in the investors' mind is regarding, firstly, maybe something like including nationwide new birth subsidies, which the government has already been working on, and also including the financial support from PBOC for expanding consumption. There's still something more details that are pending as well. So basically, we definitely believe that there will be more to come in terms of boosted domestic consumption. And if you look at the market reaction, we believe that generally the market has been quite positive in terms of the gradual recovery of the domestic consumption. So recalling that last Thursday, after the market announcement about this media briefing came out, so together with some cities like Huhehata launching new birth subsidies on the same day, the share price of domestic demand exposed names started to fall run since last Friday, including high beta names like Baijiu, Sportswear, etc. These are mainly valuation catch-ups. So since actually these additional information in the 3 p.m. meeting are actually quite on track, we believe going forward, the continued policy detail announcements, as well as the company outlook that's going to be shared during the coming results season is going to be very, very important. Thank you.
A lot of these issues are longer-term structural and even demographic. Right. Do you expect that these policies could have a meaningful impact when it comes to those sorts of economic drags, and what sort of sectors could benefit from that, given that we have seen, you know, such a big drag when it comes to, for example, companies and sectors that are related to falling birth rates?
Mm-hmm. Yeah, this is a very good question. I would say, in fact, actually every policy that is contributing to the long-term healthy growth of economy would firstly, takes time to take effect, and takes time to show a long-term impact. So as a result, the sustainability of the policy, as well as the constant effective execution, is very, very important. So at this step, we do believe that if there could be an effective nationwide new birth encouraging policy coming into place, this would definitely have a help on the long-term demographic structure of China, to at least in the risk prevention perspective. And also, as we mentioned, that the sustainability of the income recovery is one of the most important focus of the market, which definitely requires the consistency of the policies. If you recall that, like one decade ago, households leverage ratio was actually 30 percentage points below where we are right now. Currently, we're at 64% household leverage ratio. Well, the disposable income year-over-year growth is currently normalizing to mid-single digits. So under this context, definitely, for the policies in terms of not just like demographic, but also in terms of, the local government debt resolvence in terms of the sustainability of housing market should be very, very important.
Chris, you're recently back from a Europe and US roadshow. I'm wondering if you can tell us a little bit how investor sentiment is towards Chinese stocks at the moment, particularly consumer discretionary stocks, against this backdrop of uncertain tariff and trade.
Yeah. So during our Europe and US roadshow, definitely we're teasing the sentiment among global investors, and we definitely noticed that under a low position of the in China consumer stocks, we noticed an incrementally positive, sentiment for investors to come back a little bit and look at and reassess the, the growth thesis of, China consumer names. And of course, since every, measure of the China consumer policies are still takes time to see the effectiveness and to see the, the outcome. So people would be likely to be selective at a early stage. However, we do notice that for some sectors with long-term structural growth thesis with top-down supportive, policies help. We can see that interests like in sportswear as well as also in the home appliance are quite strong, and people are increasingly willing to understand more about the niche sectors growth thesis that have been occurring in China market in the past, few years when downtrading and uptrading scenario coexist. For example, like the IP retailing business. For example, like the emotional value generation consumption. These are stories that people are willing to understand more of. While some other stories might be under relatively more debate, right, with maybe more mixed variables from macro environments.
Chris, we're almost out of time, but I just wondered if you could briefly talk to me about something else you mentioned called AI plus consumption. I do get the feeling we kind of tack AI onto almost every word we can think of at the moment. What do you mean by AI plus consumption? Can you unpack that for us?
Yeah, so if you look at the 8 pillars of, special action plan to boost consumption, as well as the State Council executive meeting, the AI plus consumption was frequently mentioned in the government document. Basically, this is in line with what we have been seeing, that AI development has been helping with the productivity boost in China right now. So what can be implemented and monitorized in consumption area can be in a very broad territory. For example, like digital eyewear, etc. These are all very reasonable ways to monitorize actually the AI scenarios development. So basically, not only in China for these smart eyewear, but also globally, this concept is definitely being very popularly traded as well. So actually, examples like this has a lot of other in other areas. We definitely see that this could be a very good monetization angle to boost consumption going forward. Yeah.
All right, Chris Gao, consumer research analyst at CLSA. Thanks so much for joining us. We have more ahead on the Asia trade. This is Bloomberg. BYD has unveiled a new battery system that the Chinese automaker says will charge EVs in 5 minutes. The manufacturer is set to start selling vehicles with the new technology next month. Let's bring in transport reporter Danny Lee. So 5 minutes, a first reaction, Danny, this sounds too good to be true. Secondly, this sounds like it's going to be quite disruptive. What more can you tell us?
Yeah, this is a goal of BYD to try and design and create electric vehicles that can charge in as fast a time as it takes to drive to a petrol station or get at a petrol station and fill up a car. So that's their stand of being as quick as filling up a car. And yeah, it's set to a whole new benchmark when you consider the peers out there. I mean, most recently last week or in recent weeks, we've had Mercedes come out with their own new electric vehicle upgrade that charges for 330 kilometers in 10 minutes, but this BYD over 400 kilometers in 5 minutes, and much better than, say, like Tesla, who is the nearest competitor in terms of size and scope. So, BYD very much setting a standard, not just with a whole new electric vehicle platform that will set them on a motion for future models to come, but with a new battery as well that's all designed around super ultra fast charging and more reliability.
In the meantime, we've seen President Trump unleashing tariffs to shield the likes of Ford and GM at home. So what sort of impact could we see when it comes to what the Chinese brands are having in other markets, even if we're kind of putting aside the impact within the Chinese market?
Yeah, I mean, you look at emerging markets now on the streets of Johannesburg, Sao Paulo, and Bangkok. You just see the real-world effect of Chinese auto brands that are increasingly being seen in terms of their presence. BYD in particular, Chery Auto, Great Wall Motors. These are all side by side in car lanes that you see local with a Volkswagen, a Ford or a GM branded cars. So there is there's certain penetration that these Chinese car brands are having in emerging markets in a way in which it's a testament to how well they've been making inroads and where they have been encroaching and going into markets where they do not have the barriers such as tariffs, which, as we've seen with the US, they're trying to slow down the Chinese car makers and effectively prevent them from entering the world's biggest auto marketplace. But when you have no barriers and the threat cannot be contained to protect particularly the US auto brands, in many ways, the Chinese car brands are running amok and they're having real success without having to overcome the challenges of tariffs.
Yeah, certainly a few years ago you wouldn't see a Chinese EV on the streets here in Sydney, but now it's quite common to see BYDs. So specifically, what does success for Chinese auto brands look like around the world? And is there a cautionary tale here for top-tier automakers?
Yeah, for the Chinese auto brands, the rate at which they are seeing success, they are getting up to around a market share by the end of a decade of 13% outside of China. But if you include China, their market share will be something like 33%. So that's a real impact in terms of numbers globally. And even in places like Thailand, their market share has gone in the last couple of years from 5.5% to 13%. So it's a real kind of like a attack on the global elite of auto brands. And so that just shows, even if numbers sound small right now, that does represent tens of thousands of cars and lost sales for some of the big automakers, the established automakers out there. So yeah, more of the change and more of the same in terms of the seeing these Chinese brands on the streets.
Bloomberg transport reporter Danny Lee there. Let's get you caught up with some of the other corporate headlines that we're following. And Alphabet is said to have restarted talks to buy the cloud security company Wiz for $33 billion. Our sources say a deal could be announced as soon as Tuesday. A tie-up would be Alphabet's biggest ever acquisition, boosting Google Cloud's cybersecurity offerings to help it compete against Amazon and Microsoft. Hong Kong's New World development is said to be in talks with luxury giant Louis Vuitton to open a mega store in one of its signature malls. Sources say the shop would occupy about 40,000 square feet at the K11 Musea complex, making it one of Louis Vuitton's largest in Asia. We're told that it could feature a museum, a cafe and a lounge for the brand's VIP customers. Well, the US Federal Trade Commission is preparing for a trial next month aimed at forcing Meta to sell its Instagram and WhatsApp businesses. FTC Chair Andrew Ferguson says his agency has the resources to take on big tech and other industries, telling us that the Trump administration wants to foster innovation.
I think if you are a big tech company, you should be getting your lawyers to give you great advice on complying with our competition and consumer protection laws. Look, I don't have a particular axe to grind within the industry, but I do think it's very important that the FTC devote its resources to the markets that Americans most frequently engage with. It's not just big tech, although that's definitely one of them. It's also healthcare, and it's protecting American as laborers. But no matter who you are, I think it's important to proceed like the FTC is a vigilant cop on the beat. We're surveying the markets. We're looking for competition problems. We're looking for violation of the consumer protection laws. And if we think they're there, we're going to go to court. But most importantly, if we don't think that there are problems, it's really important for the FTC to get out of the way. Again, one of the most consistent complaints that I've heard about the previous administration was a lack of certainty and a tendency to want to do a lot of regulating. The FTC, we're not regulators. We're cops on the beat. We police for competition problems and consumer protection problems, but we're not trying to regulate the economy. We want to create economic conditions that allow, companies to innovate, to grow, and to help lift the whole country out of this debt crisis and bring about the golden age that President Trump has promised the American people.
Talk about striking that balance, because many would say, if I look at Europe, they regulate too much. There's too much enforcement, but in many ways, they're being a strict cop on the beat, some would say. So from your perspective, are you seeing over-regulation in Europe? And is there a worry about stifling innovation in the United States by the amount of focus you have on big tech right now?
Well, I do think that Europe has a real regulatory problem. It has an innovation problem, and we definitely don't want to create conditions here in the United States that suppress innovation. But I think it's important to bear in mind, monopoly suppresses innovation. Monopoly makes it very difficult for little companies with the next great idea to sort of rise. And I think it's very important, if we want to sort of preserve the American innovating spirit, that we create conditions in our economy that allow little tech, who have the next great ideas, the next life-changing ideas for all Americans to thrive. President Trump has been pretty emphatic on the importance of making sure that our economic system allows little tech to bring its ideas to market. And that's what antitrust really does, is it prevents monopoly, and monopoly stifles innovation. So if the antitrust cops are vigilant and are making sure that they're protecting us from competition problems, it allows the innovation that has made America and our economy sort of the driving engine of the whole world.
What deals do you think can get done? Is there any prescription you can give as to this M&A will look good if you are a big tech eyeing a little tech?
I think that the deals that can get done are the deals that are lawful. And I think the most important thing I want to take away from this is I see it as my job to scrutinize deals consistently with the timeline Congress created in our antitrust laws. And if we think that they are illegal and we think that we can win in court, we're going to go to court. But if we don't think that they are illegal or we don't think we can win in court, the FTC is going to get out of the way. Again, I've heard this complaint a lot from the business community that in the previous administration, a deal would enter the FTC and it would sort of disappear. And sometimes it could disappear for months while, novel ideas were floated, different theories. And sometimes it sort of seemed like the FTC was hoping that deals would die on the vine while they waited for regulatory clearance. I want nothing to do with that. If a deal is illegal and I think we can win in court, I'm going to go to court. But if it's not, we're going to get out of the way and we're going to let deals go forward.
That's FTC Chair Andrew Ferguson speaking there with Bloomberg's Caroline Hyde. Well, it was a positive day for US equities. We're seeing some of that positive sentiment spilling over into the Asia Pacific at the moment. S&P, the ASX 200 just turning positive, every sector turning positive now. Materials was losing a bit of ground earlier. Now that's in positive territory as well. The index as a whole better by nearly 0.9%, seeing a big push higher for Nikkei futures as well. S&P futures currently unchanged. Just one stock to note as well in Australia, Austal, the defence contractor, jumping by more than 6%. This is after South Korea's Hanwha Group takes a 9.9% stake in the company, paying 445 Aussie dollars a share. That's a 16% premium to Monday's close. Hanwha itself, another defence contractor, has also been performing well in South Korea. Defence stocks everywhere doing well in the current environment. And we're just seeing S&P futures there just turning negative, but we're setting up for a positive open in Tokyo at the top of the hour. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how commodities are doing, particularly copper. That rally continuing to roll on. Copper's now up about 20% on year. We did see China's industrial production post a beat for the month of February. That was yesterday, that data. So the optimism there that this rally can continue. Might be some front running of tariffs here as well, which is supporting prices. And also there was an attack on a mining camp in Peru, so maybe some nerves on the supply side for copper as well. But those gains continuing to push ahead. The oil price is interesting as well. We did see it move higher on a risk premium. President Trump is saying that any more Houthi attacks in the Red Sea, well, he's going to hold Iran responsible there. So potential tension around the oil price. We've got at least one fund placing a bullish option that Brent's June contract is going to rally towards $100. We shall see. The iron ore price still holding steady just above $100 a tonne. The materials sector's just turned positive here in Australia, as I mentioned, Heidi.
Yeah, and in terms of we shall see what we have in terms of a reaction when it comes to these Japanese trading houses as well, because it is the Berkshire, the Warren Buffett effect, Berkshire Hathaway upping its stakes in 5 of Japan's biggest trading houses. We know that this is a strategy that they've had for some time, but the likes of Mitsubishi Corp, Mitsui & Co., the average holding is now just under 10%, so 9.3%. So we could see obviously support in the Tokyo session for these names, but also perhaps wider support for the broader Japanese stock market as well, despite these ongoing sort of global economic concerns. We're also seeing potentially that those stakes could potentially go even further, because these companies have agreed to potentially relax that 10% ceiling on the stakes.
Interesting as well, because the Nikkei's down about 6% so far this year. So when you look at something like this, you can't help but wonder, is this a question of Warren Buffett being greedy while others are fearful? But as you say, those big houses are going to be watched closely. Market opens in Seoul and Tokyo in a moment. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens, and no doubt we'll see a bounce as we get into the start of trading in Tokyo and Seoul today. But the question is sort of how sustainable, right? We had that sort of relief rally on Wall Street. Perhaps the economic outlook is not quite as dire. Perhaps we're getting some more consumption support measures from China too. Yeah,
well, it's been a while since we've had an outrageous statement about trade or tariffs, but one does sense we could be in the eye of the storm here, because on April 2 we have what President Trump is describing as the big one, but in the meantime at least markets seem to be recovering. Yep, despite of course ongoing geopolitical uncertainties, how Russia reacts to this ceasefire agreement, and of course some of those comments from President Trump on Iran and the Houthis are being processed in these oil markets as well. But let's get you straight to the market open, and of course as we head into that Bank of Japan decision, no big move expected, but certainly a big move when it comes to the longer end of Japanese government bonds, JGBs on the 40 and 30-year yield, seeing either record levels or sort of 3-decade high levels there. The Nikkei 225 sort of straight out of the gate, we are seeing a pretty strong start to the session with that lead from the bounce on Wall Street. In particular, we'll be watching some of those Japanese trading houses with that increased stake from Berkshire Hathaway. A big sort of weight to the upside today. The top picks is also up by just over 1%. Dollar yen just under that 150 level at the moment. Taking a look at Korea, where this is the picture as we get into the first few minutes of that open. The Kospi is up by about 0.7% there, as we sort of have been a little bit concerned about emerging market ETFs being pulled out on these US growth concerns, but that's certainly not being reflected in this morning's session in Korea at the moment, Paul. Yeah, let's take a look at how we're tracking in Australia as well. Very much a risk-on session at the moment. So we're seeing every sector on the ASX in positive territory, including the materials sector, which was a little bit softer to begin with. Not a great deal of change there for the Aussie dollar. We did hear from the RBA Assistant Governor, Sarah Hunter, who did acknowledge that the RBA is looking at, considering risks around the trade picture and geopolitical uncertainty, but the RBA remaining data dependent. So not a great deal of change in the Aussie dollar on those remarks, and no change at all for yields at the moment. The US 10-year still parked just below 4.3%. We did see only modest declines in the US session there as well. We are, of course, got a lot of central bank decisions this week, not just the BOJ, but the Fed as well. Now, plenty to watch. So let's bring in Richard Harris, CEO of Port Shelter Investment Management. So Richard, we did see modest recovery in US markets today. I'm just wondering as to your view about the sustainability of that, and whether you anticipate this rotation into China may continue.
Well, it's always nice to see some green. It makes us all feel a little bit better. But I can't help feeling Friday definitely looked a bit like what we used to call a dead cat bounce, if you're still allowed to say that. And I think, markets elsewhere are following on. You said a moment ago we've had 2 or 3 days without any major pronouncements from the steps of Air Force One, so that's always a good thing. But I think that, we're still in a situation where the biases in the US don't look that good. We've got interest rate likely to stay high. We've got supply chains being damaged. We've got a bit of a bias of weakness in the US dollar. The strength in gold, all of these things are tending towards slowdown in the US as a result of Trump's policies. But then on the other hand, you've got China. As we've seen, they are clearly, the direction of travel is very much looking to stimulate growth. So with the authorities there looking to put money into the economy, yes, I think people are concerned that they're not coming out with any real definite moves at the moment, but there's plenty going on behind the scenes, and there's plenty already been happening. So I'm very much in the corner of saying, we're looking at the great pivot from the US to China at the moment.
Is that how you're trading around some of this volatility right now? Can you talk to us a little bit about where you're putting money to work?
Well, last September, it was quite clear the authorities were moving in that direction. And in a sense, they need to. You can't have an economy like China that's moving along sluggishly for 2 or 3 years without action happening. The consumer has been whacked in China in terms of the fact that they had 3 years under lockdown. And I think it's time to come back. To my mind, a lot of the indicators are past the bottom and turning around at the moment. There's more than green shoots going on. Certainly I was looking to move into China probably around from September, October because of that. I wasn't so sure whether to move out of the US, but then again, a lot of those stocks have done so well. So if you're a portfolio manager, you have to sit there and think, well, I've got some big weightings in the Magnificent Seven now. Do I really want to have them? So it seemed to be sensible to take some money out of there, put it into China, but also keep a little bit behind in cash.
Where are you keeping it in China, given that we do continue to see this outperformance, right? Is it onshore, offshore? Sort of what assets and sectors are most compelling right now?
Well, of course, this is why Hong Kong's so interesting. It's an option on China because, if you buy Hong Kong when China's doing well, you do better. When China's doing worse, Hong Kong does worse. So I think Hong Kong's the place to be at the moment, where, of course, you get all of these major China counters. And I have to say I'm not being very adventurous. I think the tech sector is still very interesting, and I've been moving money into there as well. But I also think that, some of the consumer stocks look as if some of the online retailers perhaps the place to be. And I also have a little bit of the domestic market, the A50, but the issue there is that they haven't really moved or haven't really moved yet. But you would expect that they would be a beneficiary of some of these consumer movements by the authorities in China.
The other big market that has seen quite a bit of enthusiasm is Europe, right? Particularly when it comes to the hopes of rearmament or defence spending. Is that still a sector that has further rallying to go, particularly as we're sort of watching in light of geopolitical developments, be it when it comes to Ukraine, but also now starting to heat up in the Middle East as well?
Well, I was a Europe specialist for 10 years, so I'm naturally biased. But I have to say, I think the situation in Europe, clearly if we're going to see a US slowdown, it's going to be tough for Europe to knock that. It's also difficult to see a wider movement in Europe. But yes, I think the defense sector looks interesting. Clearly, some of the industrial companies, and there are some very large, big industrial companies that could repurpose some of their lines towards the defense sector. So, yes, I think there's certainly opportunity there. The issue with Ukraine, of course, I think is intractable because although the Ukrainians have now put forward agreements for the US plan for a ceasefire, it's going to be very, very difficult, I think, for them to bring Putin into line. He has no real need to. He's too far in. And I think that, at best we might have some form of ceasefire. But I think if it's on a lot of the terms that Putin wants at the moment, it's going to be very difficult for the Ukrainians and indeed the Europeans to agree.
Yeah, and against that uncertain geopolitical backdrop, we now have gold above that $3,000 per ounce level. I know you mentioned gold a moment ago. Do you see that continuing to rise? I mean, I know it doesn't pay you anything, but what sort of allocation is good to have at the moment?
Well, I always think you should have a little bit of gold in your back pocket. The problem with gold is you go through long periods where nothing really happens, and then on a Tuesday afternoon, all of a sudden the metal pops and it's up 20%, and that's happened now as far as I've been in the markets, the last 30, 40 years, which is why I think it's always useful to have some little bit of gold around, and indeed oil as well, because you never really know when it's going to move, and it adds diversification. The thing about gold is that it's had the confidence of investors for 5,000 years. It's tough to knock that. But whether you put a majority or even a large portion of your money into gold, I'm not so sure. It's just something you keep there for diversification purposes, but something you need to have.
Richard Harris here at Port Shelter Investment Management. Always great to have you with us. We were speaking earlier about the Berkshire effect on Japanese trading houses, right? This is one investment theme that has been in place for some time, but raising that stake, we're seeing that immediate upside there with the likes of Mitsubishi up by over just about 5%, Murrumbeene, Mitsui and Sumitomo, just some of those rounding out Japan's biggest trading houses, 5 of them. The average holding for Berkshire Hathaway increasing that stake at about 9.3%, and there is expectation that that could increase further, given that the trading houses themselves have said that they could moderately relax the previous 10% ceiling on Warren Buffett's stake. So we'll see if this provides more support to the broader Tokyo stock market, given, of course, we are seeing some of these external global trade and growth concerns weighing there as well. But this was very much foreshadowed in the Buffett annual letter to shareholders, but still welcome when it comes to how these stocks are trading. More ahead on the Asia trade. This is Bloomberg.
Well, traders will be looking ahead to April the 2nd, when President Trump is expected to unveil new tariffs, and his top trade negotiators is going to be looking to inject a bit of order into that after previous announcements roiled markets. Let's bring in Bloomberg's China correspondent Minmin Lo. So Minmin, in the spirit of not surprising people, do we know what to expect on April 2?
Well, it's probably still going to be a road with many surprises, because at this point it is not clear whether the impending reciprocal tariffs will face legal challenges when it comes to the implementation, because Trump has so far been able to move very swiftly with the tariffs on Mexico, Canada and China, because he cited drug trafficking as a reason for those tariffs, and he was able to use this special economic power granted to him during times of national emergency. But with the reciprocal tariffs, tariffs, he has cited trade imbalance as a reason for those, and that doesn't necessarily fit squarely into the legal definition of a national emergency. So now the trade representative, Jamieson Greer, is trying to reinstate some parts of the traditional policy-making process, starting to ask for feedback, for public comments on these levies, which could take weeks and months and could possibly delay the implementation of the reciprocal tariffs.
And it is questioned also over the different sizes of these economies, right, which could prevent Canada from being able to do much more.
That's right. So with Canada, it is extremely reliant on the Chinese economy. It exports about 3/4 of its exports to the U.S. and in turn, it only imports about 17% of goods from the U.S. So it's a very unbalanced sort of relationship here. And that means it is difficult for Canada, and the Prime Minister has said as much, that it's not possible for them to retaliate dollar for dollar against those U.S. tariffs. And one way that Canada could have more sway on the U.S. is to maybe come up with a coordinated retaliatory action with some other trade partners like those from Europe and the UK. And he has made his first overseas trip recently, meeting with the French president and the UK Prime Minister. But so far, the Canadian Prime Minister is saying he is not going to push these other countries to create this coordinated retaliatory action. He's going to respect these countries' bilateral relations with the US for now.
Bloomberg's China correspondent Bin Bin Lo there. UK Chancellor of the Exchequer, Rachel Reeves, is defending her fiscal policy and pledging to bring down government borrowing. Reeves spoke to Bloomberg about raising taxes in October ahead of her spring statement later this month.
Of course, there are costs from any measures on tax, but there are also costs of irresponsibility. And if in the budget last year I hadn't have dealt with the £22 billion black hole that I'd inherited from the Conservatives, if I hadn't have put our public finances on a firm footing, then we wouldn't have been able to increase defence spending in the way that we did just a couple of weeks ago, and we wouldn't be able to weather the global economic headwinds. Yeah. So we made the right decisions in that budget to return stability to the economy. And since the general election, of course, there's been 3 cuts in interest rates, only possible because we've returned stability to the economy.
But do you regret not giving yourself more breathing space against your fiscal rules at the time of the October budget?
Well, in October, we set the fiscal rules for this Parliament that we would balance day-to-day spending with tax receipts, that we would get debt down as a share of GDP. But significantly, we changed the way that we measured investment. So for the first time ever, we count the benefits of investment, not just the costs. And because of that, we were able to invest an additional £100 billion during the course of this Parliament in capital projects, transport, digital, energy, and, of course, housing. That's pro-business, that's pro-growth, and it's pro-working people.
But I suppose what I'm saying is, isn't it the job of a responsible Chancellor to build an adequate safety cushion into the public finances so that you can weather the sort of changing world that you've been talking about in recent weeks?
Well, we inherited from the previous government not just a big black hole in the public finances, but the lowest ever fiscal headroom. We increased that headroom in the budget last October because it is important that there is headroom against the shocks that we face. But the fiscal rules we've set are the right ones. They're a robust set of fiscal rules, but it is important that we balance day-to-day spending with tax receipts and that we get debt down as a share of GDP. Those are the right fiscal rules for the circumstances that we face. But when we're spending £100 billion a year on servicing government debt, I don't think anyone could seriously argue that we don't need to get a grip of government borrowing and government debt.
UK Chancellor Rachel Reeves, they're speaking in London with Bloomberg's Lizzie Burden. Let's get you to European futures that are just opening at the moment to see how we're tracking, as we do see another day of gains there as Stoxx 50 futures are up by just about 0.5%. German DAX futures also on the rise as well. We had that previous session really being dominated by that rise with securities, resources, I should say, in that sector receiving that boost. A lot of optimism when it comes to the China consumption plan there, and oil as well as healthcare rising as well. We'll see that impact on oil with the ongoing geopolitical concerns at play, Paul.
Well, President Trump and Russia's Vladimir Putin are set to discuss the war in Ukraine on Tuesday. Let's bring in senior energy reporter Stephen Stapczynski to discuss the impact on energy markets. And Stephen, we had seen European gas prices slipping a little ahead of those talks. What can we anticipate?
Yeah, I mean, I think the big focus after these talks, of course, there could be an impact on a wide array of commodity markets. But I think the one to watch in particular would be European gas. The Dutch TTF benchmark has been moving quite sporadically based on geopolitics and the will they, won't they nature of a potential ceasefire in Ukraine. The reason for that is because there are traders who are speculating if there is a ceasefire, that could potentially down the road maybe lead to more Russian pipeline gas flowing into Europe. Europe has significantly reduced their imports of Russian gas since the war in Ukraine began in 2022. And if that Russian gas were to flood the market again, that would be a lot of downward pressure on European gas prices. We are far off the record high levels of 2022 energy crisis level gas prices, but we are still higher than the pre-war levels. And any sort of indication that a ceasefire could lead to return of those flows will result in prices falling. There might not be a physical change in actual movement of molecules across borders, but there will be a vibe shift. And European gas very much over the last few weeks has been trading on these vibes.
We've also seen that big move in copper as well. Is there really sort of that much confidence, I guess, being generated from the policies that we've seen announced, sort of bare bones as they are from China?
Yeah, I mean, you said it right. It is bare bones. The expectation that they're going to do something to kind of pull up consumption in the country is a good sign for copper. I think the market was just waiting for a reason to pop. It is tight this year. Refining of copper products has been rising faster than the expansion of mines. That being said, how long will these gains go? That's the big question, because if there is any sort of slowdown in the U.S. economy because of tariffs, if there is a wider economic slowdown, that will affect copper in particular. Metals are particularly exposed. So you have to kind of play with both of those expectations. And yes, China is a good story there, but perhaps maybe down the road, maybe later this year, if you do see an impact from the tariffs, you could start to see the market claw back a lot of those gains.
All right, Bloomberg senior energy reporter Stephen Stapczynski there. Other stories that we're following. President Trump says Chinese leader Xi Jinping will visit Washington in the not-too-distant future without giving an exact time frame. Discussions between the two countries on trade and other issues are stuck at lower levels, with both sides deadlocked on how to proceed. Trump has said he is open to talks with China on reaching a fresh trade deal, even as he intensifies pressure on Beijing. A senior Taiwanese security official says the island expects continued support from President Trump's administration in the case of hostilities with China. And that would include supplies of U.S. weapons and training for Taiwanese soldiers. The comments come with Trump upending global alliances, raising questions about U.S. support for longtime partners. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching just about 25 minutes into the start of trading in Japan. The Nikkei 225 up by a comfortable 1.3% following that rebound on Wall Street. Watching yields, but particularly on the longer end, 30-year as well as 40-year. 40-year hitting that record in the previous session. The 30-year also at sort of decades highs there at the moment, as we are expecting the Bank of Japan to hold the rate steady amid these ongoing concerns over global growth there. We are watching in particular when it comes to stocks that are in focus, these Japanese trading houses, the big five, seeing that upside after we heard Berkshire Hathaway increasing their stakes, the likes of Mitsubishi, for example, as well as Sumitomo. And really, none of this was terribly surprising. The average stake is now at 9.3%, and we could see that increase even further. So quite a bit of upside there for the big trading houses. Our Bloomberg stocks reporter Momoko Yokoyama joins us now for more. So this is a play that we've seen from Warren Buffett for some time. Why are we seeing now trying to increase the stake and potentially even increase it more if these houses relax that 10% cap?
Yes, so Buffett's increase in his holdings of Japanese shares came after his annual letter to shareholder late last month. So in his letter, he re-endorsed his holdings, saying that he's willing to increase its ownership, and also he said that he intends to hold these shares for long term. But it's also likely that Buffett, of course known for his value investment strategy, found the current share price and valuation of these shares quite attractive. Since the August sell-off last year, this valuation has plunged. For example, Mitsui & Co., its PER has dropped over 36%. From its peak in 2024. So it's not entirely surprising for the market participant in Japan, but I think the valuation and the current share price has took a part in deciding factor.
So what's the implication for the overall Japan market? Could this be a rising tide that lifts all boats?
Yes, so the trading shares that he holds is up today, so its impact on his holdings is quite obvious. But at the same time, it's likely that it will provide some boost to the overall Japanese market as well, especially Japan stocks has been struggling quite a bit this year around the concerns of stronger yen and also a better performance of the market elsewhere. So I think the endorsement and actual buying from Buffett could provide much needed support for Japanese market overall.
Yeah, you mentioned a couple of other factors there, like the stronger yen. We also have policy normalization. So against that backdrop, what's the outlook for the broader Japan market going forward?
So there's been some signs of bottom up for Japanese stocks with strong earnings and also quite reasonable valuation. But at the same time, what I've been hearing from investors is that they need more stronger, more positive momentum before confidently start building stake in Japan. One of the reasons, the risk that they see is, of course, stronger yen that could weigh on exporters with the BOJ likely to.
Our Bloomberg stocks reporter Momoko Yokoyama there. Keep an eye on JGB yields, as we were saying, particularly at that 30 and 40-year tenure. The 40-year briefly topping 3% yesterday. Take a look at how China assets have been trading. Of course, there's been quite a lot of enthusiasm, even though Bloomberg Economics has called the latest announcements when it comes to these consumption-driven policies as skeletal, but headed in the right direction, and certainly looking at perhaps addressing some of the demographic and structural chokeholds for the economy to bring household confidence and spending, and really just the question of broader animal spirits back to this market. Having said that, this is, of course, a market, particularly when you talk about offshore trading, that has already rallied quite enthusiastically. A50 China futures, the last close positive. The Golden Dragon Index, if that's a gauge, trading in the US overnight up by over 4%. Dollar China pretty much unmoved at this point. But Chinese stock investors, of course, really looking now to the upcoming earnings season after that announcement on measures to boost consumption. Really not adding much when it comes to fresh catalysts for the market. Our equities reporter April Ma joins us now. So what was the biggest takeaway when it comes to the press briefing on consumption? Because we have seen certain assets rally, certainly the likes of the copper markets, for example. So there is some excitement, even though it was very low on details.
Yeah, I think we've seen the policies being described as very vague, low on details, unclear on implementation. And I think it's understandable that the market traded more to the downside after the plan and ahead of the presser yesterday. I think we need to take into account the fact that they have rallied up till this point, so that with gains like this, investors are probably going to want to see more immediate gains or immediate impact on earnings rather than things that were announced like that were more long-term. So I think that's understandable. I think another thing that really stood out to me was the fact that Liangye, the liquor maker, yesterday was among the most traded stocks in Shanghai and Shenzhen, but the stock itself did very little. So what that shows me is that there's a lot of discord among investors. Some of them might think this is the time to go back into these blue chips, so these very property-linked kind of consumer types like be it Baijiu or be it appliances and furnishing materials. But others are thinking that the consumer rally this time may look vastly different than it has in past cycles, and that it may be very tech-heavy. So as you mentioned, the rally in copper, I think that what we're pricing is more of those gains in tech names, be it more smart appliances and software.
Some of the southbound flows that we've seen over the stock connect have been an important driver of the rally in Hong Kong. Are we seeing any sign of fatigue from that yet? And what are they buying?
I think it's a little bit too early to say fatigue. When we saw 2 days of record inflows last week, I think people are getting a little bit wary because it was bringing back memories of the 2021 rally when southbound was again very upbeat. But I think this time things are looking distinctly different. They're still swooping in to buy any dips. Like we saw yesterday, there was another 10 billion Hong Kong dollars of inflows, and that was led by buying into the broader gauges, which was the tracker fund. So they're not only concentrated on buying Tencent, Alibaba, and the other tech names. They're also spreading the love a lot. So they're buying Xiaomi, BYD, Meituan. So it's all the tech names and then the gauge. So it feels like the degree of optimism this time is a lot more sustainable.
And of course, we've seen the sort of AI and tech-driven enthusiasm being kicked off by DeepSeek, by Manus AI. How much pressure is there on broader China tech? Because some of those names that you just mentioned are also due to report earnings.
Yeah, again, I think we have to take into account their trajectories ahead of earnings. So if we're thinking about firms like Xpeng, that stock has more than doubled this year. So on the back of the unveil of BYD's latest charging platform that can fuel a car up in 5 minutes, I think that's going to see a lot more pressure to take profit. Whereas for firms like Xiaomi, which is expected to see a 43% jump in revenue in the fourth quarter, I think people are still going to be pretty long on that story, and I think they're going to be a little bit more tolerant, even if we don't see a significant narrowing of its losses on the EV segment. When it comes to Tencent, I think that stock has not rallied as far as its peers. So I think investors are again going to be more generous.
All right, equities reporter April Ma there. Thank you. Well, let's get a little more on Xiaomi. The success of its EV business is going to be in a primary focus when its earnings are due out later. The Chinese tech giant's likely to record its fastest growth since mid-2021, as it also benefits from stabilizing smartphone demand. So for more, let's bring in our tech reporter Annabelle Drewlers. So Annabelle, can you share us some more details on what we're expecting from Xiaomi?
Yeah, well, I think you sort of just shared that top line, really, that these are expected to be strong results, and there's going to be that focus on the EV division and the smartphone division in particular. So we've got a breakdown of the different parts of the business and exactly what we're expecting later. But smartphones, for example, they're going to come in likely just under half of the total revenue you can see here. Smartphones as a business, maybe the sales growth might have slowed a little bit, but that was also just due to higher base comparisons or comparison base. But we could have actually seen the margins improving, and that's because maybe Xiaomi is continuing to make headway in getting more of a pie of the premium smartphone market, because they do have a premiumization model in place. So smartphones, EVs, you can see there, that again is becoming a more significant segment for the business. You think they only just started selling their SUV back in April of last year, so you're not even a year into that just so far. Prices, again, they're going up for these vehicles because they're selling more of the Pro, more of the Max models, and IoT as well, something else that's very important to track. That's Internet of Things and lifestyle. That segment really speaks to Xiaomi's overall business strategy. They try to own parts of the entire ecosystem. So your home, which is, of course, home appliances, what they call the human, but that really means your smartphone, and then the car as well. And so that is really the Xiaomi strategy. And again, IoT could have benefited from the push from Beijing with these stimulus programs or trade-in subsidy programs. So, yes, an area that could have benefited from consumption. But you can see there that huge rally in the stock that we've seen, up nearly 300% or quadrupling over the past year.
So does that tell us that it's already sort of priced to perfection?
Yeah, it's going to be interesting to see exactly how the share price reacts after these numbers, because what has happened is now the stock has rallied so much that it's even trading above the average price target from analysts. And so, you know, it's difficult to know exactly how high the bar is for this company, rather, given that you've seen so much success to date. But what we do know is that the investors have been boosting their options bets, and they're certainly expecting more volatility. So generally you might see a swing of maybe 3% in either direction for the Xiaomi stock after the numbers. Tomorrow, though, what we're expecting and what's implied is a move of around 7%. Again, in either direction. So a lot of anticipation for what exactly comes out of these numbers later today.
Annabelle Drew-Ellis there, and we'll be getting more on Xiaomi's earnings and the outlook tomorrow. We'll be speaking exclusively with the CFO, Alan Lam. It's coming up on the Asia Trade at those times on your screen. Well, BYD has unveiled a new battery system that the Chinese automaker says will charge EVs in 5 minutes. The manufacturer is set to start selling vehicles with the new technology next month. Let's bring in our transport reporter, Danny Lee. Danny, I mean, I'd like to be able to charge my phone in that period of time, right? What are the promises being made here?
Yeah, BYD is promising to charge EVs in the same time it takes to refuel a conventional gasoline car. So they're making bold claims here, and you know, the fact that you can extract 400 kilometers of range in 5 minutes, far more than the standard EVs on the market, particularly something like Tesla. They're really setting a really all-time high new benchmark when it comes to performance, to technology, and the kind of cars, EVs particularly, that will take them on in future in terms of upgrading on a wholesale basis the EV lineup and the EV products that it currently sells. So there's going to be big fundamental changes, but really setting in stone something very different for the future and for rivals to try and catch up to.
Well, President Trump has meanwhile unleashed tariffs to shield the likes of Ford and General Motors at home. Even if they can't get into the world's biggest car market, what impact are Chinese brands having around the world?
Yeah, I mean, in emerging markets on the streets, you've seen the likes of in Bangkok, in Sao Paulo, in Johannesburg. There's a very common scene being set here. It's Chinese auto brands which are, driving alongside. You see Volkswagens, you see Fords, and even GM branded cars. So the fact this proliferation or frequency of Chinese brands, BYD in particular, Great Wall Motor or Chery Auto being more commonplace, it kind of speaks to the testament and the success of Chinese brands being able to penetrate emerging markets, and particularly where, tariffs and the way President Donald Trump is trying to protect automakers, the US automakers at home, they are not going to have necessarily the same effect abroad, where some of these Chinese brands are happy to go into emerging markets where there are no restrictions, no barriers to trade, and so therefore are making bigger inroads, and the effect is to be seen on some of these on some of these global brands, particularly the US. So clearly there is a huge effect there, and a lot more to come in future.
Bloomberg transport reporter Danny Lee there. We have more ahead on the Asia trade. This is Bloomberg.
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1%, and next year by 0.3% down to 3%. And I mean, it's a function of the data pointing to a weakening in the global economic outlook, but also inflation remaining more elevated than we had previously anticipated.
OECD Secretary-General Matthias Cormann, of course, who is also the former Australian Finance Minister. But the OECD has also slashed Australia's growth estimate for 2026 to 1.8%. That's well below the RBA's own forecast of 2.3%. Treasurer Jim Chalmers is expected to use a speech today to warn about the negative impacts of Trump's trade war to growth and inflation. Chalmers will argue that Australia deserves better from a long-term partner and ally, but that the government will focus on resilience over retaliation. Let's get some more perspective on Australia's relationship with the US and the implications when it comes to how Beijing will navigate these waters, as all of these countries are navigating the looming trade war. Joining us now is the former US ambassador to Australia, Jeffrey Bleich. Jeffrey, an ambassador, really, really great to have you with us. And at this point, I suppose there's some solace in Australia being really in the basket of a number of other traditional US allies that are being treated the same way, if not worse, if you take a look at how Canada is going. Right? Do you think it's a matter of wait and see to see how much of Trump's rhetoric is translated into action, or do we really need to start rethinking about the sort of entire fabric of this trade and geopolitical and security alliance?
No, I don't think you need to rethink the entire fabric of the security alliance. It's a deep and valuable alliance for both countries, and it goes to our natural, affinity for one another, but also common values and a common approach. This is a break from some of the traditional American policy making in the region and our treatment of allies, and it's challenging, I think, not only for Australia but for other allied nations as well. But that doesn't mean that you abandon it or substantially rethink it. I think it just requires a certain nimbleness and adaptation, at least through this administration.
Do you suspect that President Trump and his administration are rethinking, though, some of the fundamental pillars of that relationship? He's been pretty lukewarm or sort of even non-committal as to how he feels or if he thinks about AUKUS, for example. There's been threats reportedly of kicking Canada out from the Five Eyes agreement.
Yeah, I think this president is willing to take everything to an ultimate, at least in terms of a negotiating strategy. And so he puts everything on the table, including things that we've always considered fairly safe and to diplomats like me, sacred. But that's a negotiating style. And in terms of his willingness to maintain those positions beyond the negotiation, we've seen that with Canada and with Mexico, that he announced tariffs. He launched tariffs, he unlaunched tariffs, he relaunched them, then he stepped back from them, then he relaunched them again, then he doubled them, then he didn't double them. So there's, for him, it's all negotiation, which I think is very different from how we've treated allies in the past, and it's unsettling for them, but it's a personal style as opposed to a reflection of overall U.S. policy.
As a former ambassador, I'm not sure how specifically you want to answer this question, but would you have any advice for the current US ambassador to Australia?
Well, I don't think we have a current ambassador nominated or confirmed yet, so I couldn't tell what sort of advice that they might want or need. I do think that one of the challenges for anyone stepping into that role is going to be recognizing that Australia is a critical partner for us around the world that is now somewhat rattled, and walking the line between reassuring our allies and yet at the same time not doing so in a way which puts them in an awkward position with the administration, which really
is there an opportunity?
One voice.
Yeah, I'm wondering if there is an opportunity here for China as well. We've seen the relationship between China and Australia improve. China's relationship with Canada is still somewhat fraught, but is there an opportunity to bring these non-US partners together? And I'm thinking particularly in terms of a trade bloc like the CPTPP, which China would like to gain admittance to. Do you think there's a greater role for these sorts of blocs that exclude the US?
Well, I'd certainly hope not. I think the United States made a mistake in not joining TPP and creating opportunities for other trade blocs to even exist. So I'm not a fan of our partners rethinking their expansion into different trade blocs. My general sense is that the U.S. is mostly focused on strategic competition with China. And in my view, the United States should be relying heavily upon the partners and allies that we have in the region to ensure that our values are well represented in the region and that we are stronger together. So to the extent that the administration is not communicating that, I hope that over time we'll see that from other parts of the administration and certainly from the leadership in the embassy.
Ambassador, last week we had a conversation with the former Australian Prime Minister Malcolm Turnbull. He made some comments and gave his views when it comes to the opportunity that might be arising for China, to which President Trump really pretty quickly expressed his ire to these comments. Take a listen.
I think China will take advantage, massive advantage of Trump. What my prediction will be that President Xi will aim to be the exact opposite of Trump. Where Trump is chaotic, he will be consistent. Where Trump is rude and abusive, he'll be respectful. Where Trump is erratic, he will be consistent. And what that will do is build trust with countries, and there'll be many countries who will, looking at China on the one hand and Trump on the other, will find China a more attractive partner.
And a couple of things from that. I wonder if you can see the reasons why perhaps that statement or perhaps who it came from really stoked the big reaction from President Trump. And is there an element of truth to that, with a globally receding United States, Beijing would love to take that opportunity to step up on the global stage?
I wouldn't presume to get inside Donald Trump's head, and it's not a place where I want to spend a lot of time. I would say that China is always looking for opportunities and to create wedges between the United States and its allies and partners. So I think President Xi will use lots of different devices to accomplish that. Some of it will be, as former Prime Minister Turnbull said, using some respect for these countries, looking for small wins and gains and cooperation in order to warm up those relationships, and trying to create a contrast between some of the rhetoric that's coming from the White House. So I do think that maybe you could say it in a way which wouldn't antagonize the president quite as much, but I think the point is a valid one. And in terms of how the president approaches China, he's sort of between two approaches. On the one hand, he seems to really want to have a great power relations where Russia, China, the United States are speaking to each other as respectful peers, and that each of them can do whatever they want in their spheres of influence. But on the other hand, he's also provoking China with tariffs and trade war and rhetoric. So it's unclear exactly what kind of relationship he's trying to form with China and what counter reactions that's going to create for Xi Jinping.
All right, Jeffrey Bleich, former US ambassador to Australia, thank you so much for your time today. Now we have more on Australia ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Plus, you can tune in to the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.
Take a look at the latest corporate stories that we're tracking this hour. Alphabet is set to have restarted talks to buy the cloud security company Wiz for $33 billion. Our sources say a deal could be announced as soon as Tuesday. A tie-up would be Alphabet's biggest ever acquisition, boosting Google Cloud cybersecurity offerings to help it compete against Amazon and Microsoft. Hong Kong's New World Development is set to be in talks with luxury giant Louis Vuitton to open a mega store in one of its signature malls. Sources say the shop would occupy about 40,000 square feet at the K11 Museo complex, making it one of Louis Vuitton's largest in Asia. We're told that it could feature a museum, a cafe, and a lounge for the brand's VIP customers.
All right, let's take a look at how futures are tracking. We do, of course, have the open in China and Hong Kong at the bottom of the hour. We've got futures currently looking for a bit of upside there, following on from the risk-on sentiment we're seeing in the rest of the region. S&P futures, however, just turning ever so slightly negative. All right, that is it from the Asia Trade. Markets coverage does continue as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show up next. This is Bloomberg.